If you've got a bit of money saved and you're kind of wondering what to do with it, maybe it's not quite enough for a property yet, or you already have somewhere to live, or you just want to know whether the best thing to do is to invest it or where to invest it, then you're in the right place and you should probably put on some headphones and pay close attention, because I'm going to break down in this video a guide that I wish I had about 10 years ago when I first started investing. Today I'm going to cover investing 101 for complete beginners. If you've been investing before, if you don't know where to buy stock, what a stock is, how to buy stock, do you just go to netflix.com and buy Netflix stock? Like, how does it really work? I'm going to break that down for you in this video. 5 steps or 5 questions that people tend to ask me around what to do with the money that they make. But before that, I really need you to understand what happens if you don't do anything with your money. So in the case that you put your money under your mattress or leave the money in the bank doing nothing at all. Now, what happens to your money if you leave it in your bank account, or if you leave it on your phone where you keep looking and saying, yes, I've got a lot of money, is that it loses its value over time in a phenomenon called inflation. Now, a few years ago, Nike Air Forces used to cost £65. Today, they cost closer to £120, which is almost double. Now, why is that? Well, it's because of inflation. Now, I'm not going to go too deep into that, but what you need to know is that inflation generally sits at about 2%, but at the moment in US and UK economies, it's closer to 3, maybe 4, depending on who you ask. So what does that mean for you? That means if you were buying Air Forces next year, then rather than being £120, they would cost 3% more. So the long and short of it is, if you had £10,000 in your bank account, £20,000, now let's stick with 10,000. If you had 10,000 in your bank account, and you left it there for 5 years with a rate of inflation of 3%, after 5 years, money will only be worth £8,500 and I think it's £37 if I do my maths correctly. I obviously didn't do that off head, but yeah, you catch my drift. The value of the money goes down because the cost of goods goes up. And last time I checked, our salaries weren't pegged to inflation. And so if you are earning money and you're saving money, but you're doing nothing with it, then you're probably losing money. And we don't want to lose money. And I'm hoping you don't want to lose money, which is why you're watching this video. So now that we've got that out of the way and we understand that leaving your money in a bank account or under your mattress isn't the best use of your funds. If you're new here, I'm Dr. Nix and I help doctors and professionals create alternative income sources and get financially literate and make good use of their money. Put it simply, I help you make money and I help you grow your money. Now, if you've been following me for a while now, you'll know that there are 4 main ways that doctors and professionals can increase their wealth. The first is career progression. The second, capital investments, which is what we're speaking about today. The third, skills monetization, and the fourth, business scaling. Now, if you want to increase your income, I have a 6-part series that shows you exactly how to do that. This video is on capital investments and how you can grow your income with the money that you already have. So going back to inflation, we said inflation is 3%, right? Now, some of you will say, oh, well, I've got my money in a savings account, so I'm good. Okay, well, most savings accounts will probably offer you 1% if you're lucky. Some will offer you a rate just below inflation. But the point is, even if it's, let's say it's 2%, inflation is 3%, you're still losing 1% year on year, and that compounds. So why would you want to lose money? So that brings us on to the next thing, which is investing. So this is why people invest, to beat inflation. Inflation is the enemy, and investing helps you to beat that enemy. Now, I just also need you to understand these 2 principles. Interest is not the same as investing. So you getting interest from a bank account is not the same as investing your money, but we're going to get into investing now. Now, a question that I get asked all the time is, what should I invest in? What are you investing? But I'm going to break it down. And the first thing that I'm going to tackle is property. I'm going to show you how property investment makes money, and we're going to go into some stock shares and all the other jazz that I promised you at the beginning. So when it comes to property investing, there are 2 main ways you can make money from investing in property. Now, I'm talking about the UK. This applies to most Western countries, the US, Europe, and so on and so forth. Let's say you have a house that you buy for £100,000, and then every year you rent out the house for £830 per month, and you collect £10,000 for the house every year. That means every year you're collecting £10,000, and it will mean that you'll spend 10 years recouping the investment of £100,000. So it takes 10 years for your full return of investment. Okay, so that means that you're making money from that property. Now, that's the first way you can make money. Cash flow, renting out the property. The second way is that over 10 years, generally speaking, in the Western society, the value of properties go up. And so you essentially get a capital gain on the property because the capital or the amount that the property is now worth is much higher. So let's say it doubles to 200,000. So that means you've put in 100,000, you've got back your 100,000, and the property is now worth 200,000. So that is a pretty good return on investment, right? ROI. However, the thing is with properties that it can be a little bit annoying. It takes a lot of capital. Like, how many of you have £100,000 lying around? Number one. Number two, you probably need a mortgage for that reason, which means that you have to deal with brokers, lawyers, paying fees for this, that, and the other. And then you have to pay tax on the income that you receive monthly. So that £830, if you've bought the property in your name, you're going to pay tax on it. If you've bought it as a company, then you pay company tax. But the point is, you still have to pay tax on it. Then you have to maintain the property. You have to pay an agent to rent out the property and so on and so forth. Now, I'm not putting you off property investments. I'm just telling you what comes with it. And then on top of that, when you do get your capital gains, like say it does become 200,000 and you sell it, then you pay a capital gains tax. Certainly in the UK, I don't know about other places, check your region. So when it comes to property, think about these things. But it has made a lot of people a lot of money. And disclaimer, or to be transparent, I have invested in property. I do invest in property, and it does have its benefits if you know exactly what you're doing. So the next thing you can invest in are stocks and shares. Now, what are shares and how do they work? So if you're buying shares, then this is probably the closest we're ever going to get to like this magical savings account that gives us a return that beats inflation. And the idea with shares is that when you buy a share, you're buying a piece of that company. So if the company does well, you do well. But also if the company doesn't do well, then that also means you don't do well. But it does mean that you can have a small ownership, or the best way to see it is having a bit of ownership in the company. So let's say, for example, what is this? This is a Shure microphone. Let's say that they have a very profitable year and they sell 1 million microphones or 1 million more billion microphones. Then there are two main ways that you can make money from that. One, let's say the company sells 1 billion microphones and then shares that profit with everyone who's a shareholder and gives everybody 50p. Then that means at the end of the year, you've gained 50p and you still own your share that you've only paid, let's say, £1 for. The second thing is that if they sold 1 billion microphones, the company's probably worth more now. And so your original share might be worth £2. So now your share is worth £2, you've received 50p, and you still own part of the company. So if the company continues to do well, you continue to do well. And that's kind of like the basic way that I can break up shares. And those are two ways you can make money. Dividends shares, where you get a piece of the company's profits on a timely basis. Some companies it's a quarter, some companies it's a year. That's the first way, dividend shares or dividend stocks. And then the second way is just the appreciation of the capital. So it's a bit like property in terms of, your property gets you rental income, but also goes up in value at the same time. I hope that makes sense. If it doesn't, pop a comment and I will explain it more clearly. So you're probably thinking, okay, great, this sounds fantastic. I want shares in companies. How do I buy a share? Well, the way you buy shares are through brokers. Now, this is why I say it would have been nice to know some of this stuff 10 years ago, because a while back, in order to buy shares or get hold of pieces of companies was more difficult than it is now. Now you can pick up your phone, you can use Trading 212, Hargreaves Lansdown, you can use Vanguard, you can buy shares at the click of a finger because it's on your phone. Before, you had to call up a broker, you had to put an order in, they wrote it down on a piece of paper, they took it somewhere, and then they paid for your share or your stock, all right? But now you've got it at the click of a button. So you can actually just go to an online platform which acts as that broker, where you just register, put your details in, and then bada bing, bada boom, you're buying whichever share you want to buy that is publicly traded. Now, you can only buy shares of companies that are publicly traded. So if the company is, not currently public, and I'll do another video about what that means with a public company or, private companies and so on and so forth. But let me stick to this because it's really simple for beginners. So that is how you buy a share. Now, every country has different brokers. So in America, it's different. I think it's TD Waterhouse a lot of people use. In the UK, there are so many. If you want a recommendation, I can put some links below. I'd say Trading 212. Hargreaves Lansdown has quite high fees, but they have a wide range of shares shares that you can buy. So if you want to buy a lot, then Hargreaves Lansdown, but the fees are a bit high. But I would start with probably trading 212. The next question is, which shares do I buy? And the thing is, with individual stocks, they're kind of a bit risky if you don't really know what you're doing. So if you, I don't know, maybe you did buy stocks in Sure, but you didn't know that Sure have competitors Road, and Road are about to take over the market, and Sure crashes, then all your money's gone. So if you do that, your chances of losing are higher, because do you really have the time to research? So the next question then is, what do I do instead? Well, the next best thing is an index fund. An index fund, you have the index bit and you have the fund bit. Now the index bit is essentially a group of companies that are put together. So for example, you have the FTSE 100, which are the top 100 companies in the UK, or you have the S&P 500, which are the top 500 publicly trading companies in the USA, or the NASDAQ or the Dow. And essentially they're companies who have been grouped together. Now what these companies do is they give you a temperature of what the economy is doing, because if you're trading across the top 500 companies in one of the largest economies in the world, then if one company goes down, if Apple goes down but Ralph Lauren goes up, then you're kind of hedging your bets a bit. You're diversifying because you've got a share in 500 companies. Now, these index funds are usually sold to you as ETFs, which are exchange traded funds. Essentially, that means that you can have a piece of all 500 companies, if that makes sense, or a fund that is tracking the top 500 companies in the S&P, or the top 100 companies in the UK, which is the FTSE 100. Now, what the fund is, it's a pooled resource. So you put money in, I put money in, 10 other people put money, we all put our money in, and then that fund buys pieces of those companies. I hope that makes sense. Now, when you do that, that means that if, 10 companies go down, but 10 companies go up, your risk is less, essentially. Is the shortest way to explain that to you. It can go down, it can completely go down, but if you look at the S&P 500, for example, since 1980 or whenever it started, it does trend up. So there will be crashes, there will be dips, but if you zoom out, it tends to trend upwards. Now, this isn't financial advice. I must put that caveat in there. Do whatever you want with your money. I'm just explaining to you how things work. There was a crash earlier on this year in April when most stocks dropped 30% and everyone panicked and sold. The thing is, if they bought more, or if they just waited and, let it ride out, but if you just waited and just ride the wave, then we're up now. Like, we're back up. Like, I was down, I remember one investment was down 30%, it's now up 50%. And if I'd sold it then I would be down. So when it comes to risk and it comes to like, oh my gosh, I don't want to lose my money, you've got to just think a bit long term. The good thing about index funds is that they have lower fees than, like, say, mutual funds, because they just essentially use a computer and an algorithm to work out which stocks and shares to buy, and then you invest in them. And also you can see the past performance. Now, past performance doesn't mean it's going to perform great going forward, but it does give you an idea of the sort of trends that you expect to follow. Now, if you've ever heard of one of the greatest investors, the Oracle of Omaha, Warren Buffett, he advises for you to invest in index funds. He put it to some fund managers that if he just put his money into index funds and they picked all the best stocks that they could research, that he'd still beat them. And it was a 10-year bet, and after 10 years they were pretty much the same. And so he proved his point that if you're an average or beginner investor, you're better off just putting it in an index fund, because even experienced people couldn't necessarily beat those funds. Okay, so we have solved the problem of which stocks to invest in by completely eliminating that option to begin with. We've circumvented having to pick stocks by just putting the money into index funds. Now, the next big question that people ask is, oh my gosh, isn't it risky to invest in the stock market? Now, that depends on your psychology towards money, depends on your parents. Maybe they told you, oh no, stock investing is risky because they lost money in the 2008 crash or whatever. When you invest in the stock market, everything is unrealized, as in it's not true until you sell. So if my shares or index fund dropped by 30% in April and I sold, then yes, I've lost money. But if I leave it there, then I haven't. And if I wait and it's up 50% now, then I sell it now I've sold and I've gained 50%. But even that 50% isn't real yet until I sell it. And the 30% isn't real until I sell it. So, when it comes to risk, you just got to think long term. And so if the money that you're investing, I think that in order to reduce your risk, you want to satisfy these 3 criteria. The first one is that if you're investing, I think of it as a long-term endeavor. By long, maybe medium term, depends on what is all relative, right? What's long to you? 3 months, 3 years, 30 years. What I mean is, you don't want to need that money. That money shouldn't have to be immediately available to you, because if you do have a crash and you need the money, guess what? You're going to have to sell and you will lose money. But if you don't mind and it's money that is extra, then it doesn't matter. You can ride the wave. And so I would say to invest long-term if you're investing in the stocks and shares market using index funds or with ETFs or whatever you have decided to choose. The second is, have you paid off all your high interest debts? Because in the same way that you're getting compounding interest from investing in index funds and investing in ETFs, then the same way that your debt is compounding. So if you're paying 22% APR on a credit card, but you're only getting 10% from your index fund, then you're losing that 12% compounding each year. So what you want to do is pay off your high interest debts first before investing. Because I get asked that question all the time. Should I invest if I'm in debt? Well, if you can invest in something that's going to get you better returns than your debt, by all means go ahead, but good luck finding that. The third thing is you should pretty much have an emergency fund. And this kind of ties into the long-term investment idea or principle that if you've got an emergency fund, then when you need money, it means you don't have to go to your stocks and your shares or your index funds to take that money out. And so having an emergency fund provides that buffer so that if the market does dip, you can wait. You can ride it out until it picks back up again. I hope that makes sense. So that's 3 criteria for you. 1, it's a long-term investment. 2, pay off high interest debt. And 3, have an emergency fund. Another question that gets asked, how much should I be investing of my income? This is pretty philosophical and I think maybe you guys should read this book. It's called The Millionaire Fast Lane. You've got to decide like what it is you're trying to get out of investing, right? Like, is it just something, a vehicle that you have for the long-term future that, you know what, I have some extra cash and I'm just going to put money away? Or is it something that you're trying to use to build wealth? Those are 2 very different things. In my opinion, I think everybody should be investing, even if it's a small portion, 10%, £10, £50, 50% of your income, whatever is comfortable for you. I do think you should be investing because remember, we're trying to beat inflation. So even if you just have money, you want that money to beat inflation. And if you invest in the S&P 500, for example, year on year, it's predictably given gains of 8% and above, or an average of 8%, let's put it that way. And so if inflation is 2% or 3% and you're getting 8% year on year, then you've beaten inflation essentially. So how much should you invest? The quick answer is it's up to you. Depends on your philosophy, depends on how you've decided you want to create wealth. Remember, there are 4 levers for creating wealth. For me, capital investments are not necessarily my route or my main way of generating income. It's just a way of managing what I already have. So the money that I do make, I put it into capital investments just to keep it moving so that it isn't deflating with the currency. So I'm always investing income that I generate. And so the short answer is invest if you can, even if it's 10p, £1, £100, whatever it is, get into the habit of investing. Now, if you're in the UK, there is a great thing called LISAs or LISAs, whichever way you want to call it, ISAs and SIPs. Now, these are essentially tax efficient ways of investing. If you invest into a SIP, which is a self-invested private pension, you can use that SIP to invest in index funds and so on and so forth, and it is tax deductible up to £60,000 each year. I have another video on that, which I will pin somewhere. The second is a LISA, whatever you want to call it, where the government gives you 25% of whatever you put in cash, up to a maximum of £4,000 each year. Now, there are no tax breaks with that. You do get 25% put in when you put in whatever you put in up to a maximum of £4,000. So the maximum bonus you can get is £1,000. And the third is a stocks and shares ISA, which is where you can invest and any of the returns are currently tax-free up to the amount of £20,000. Essentially, you can put £20,000 in each year, and whatever you gain from that, if that £20,000 becomes £1 million, it's completely tax-free. Now, if you put that money into a bank account and you get an interest rate of, let's say, 5%, that interest rate will be taxed. So think about that too. Think about why it might be better to invest. So I hope that's kind of helped you a bit with deciding how to invest, where to invest, how it sort of works, and basically how to start. And I think that if you really want to know the first step to take, I would say decide on a platform, decide how much you're going to automatically invest every single month or week or however frequently you receive your income, and then which index fund or ETF you are going to be investing in. So those are your 3 steps. That's your homework. Now, if you're thinking, well, I don't even have the money to invest yet, or how do I actually make more money in order to invest, then hit me up, because there are other levers in which you can increase your wealth. Like I mentioned, career progression, skills monetization, and business scaling, and I can help you do exactly that. So send me a DM on Instagram or click the link below to apply to the next accelerator, which is starting very soon, which will help you increase your income without burning out using the skills that you already already have. I mean, it's a no-brainer. I mean, what are you waiting for? Just click on the link. So by now, you should be able to confidently invest into an ETF or index fund using one platform with one amount every single month and be on your investment journey. Tell me which platform you decided on, which index fund you decided on, put it in the comments. I reply to all my comments. And if you're interested in actually increasing your income, then apply to the next portfolio accelerator, which is starting very soon. And there are limited spots. And once they're gone, they're gone. I won't be able to help you after that. Well, I will. I mean, you can join my school community too, where there's some free resources. But the point is, if you want to get ahead, if you want to go far or fast, join the accelerator.